When I first started this channel back in 2020, I had two main goals in mind. I wanted to discuss and analyze all of the major high-yielding investment types that exist, since I am primarily an income investor. But I also wanted to every now and then share my own journey as someone who's building up a massive income stream through dividends, which is likely what you're in the process of doing. And throughout the years, we've seen a lot of new investment types launch that are designed specifically to offer exceptionally high dividend yields, which is something that's really encouraging for investors like us. But one of these new investment types that's launched more recently are these synthetic covered call funds. And this is a strategy that I've only seen utilized by a company called YieldMax. These synthetic covered call funds offer the highest dividend yields out of anything you can possibly find on any stock exchange currently. And I'm often asked by people, both here on YouTube as well as over on our Patreon, why don't I personally own any of these YieldMax funds if I really am an income investor that's focused on high income for my portfolio? Today, there are entire YouTube channels that exist that are dedicated to covering all of these YieldMax ETFs that are run by these people who are investing large amounts of money into these funds. And the truth is, all of these people have the exact same goal as I do, and potentially you as well. We're all looking to earn huge amounts of passive income through our investment portfolios. Our main objective is to make an income stream that we can use to either live off dividends much earlier in life or as a means of supplementing our income during retirement. Not only that, but I'm also a fan of covered call funds. In just the last year or two, we've been seeing a lot more variety when it comes to these ETFs. And in my opinion, many of these newer covered call funds coming out are better than the older ones. And in fact, there are a few people over on our Patreon who like holding these YieldMax ETFs. But I've discussed in the past a couple reasons why I haven't had any interest in holding any of these YieldMax ETFs myself, despite their insanely high yields. One of the first reasons why is that these YieldMax funds are not well diversified. Almost every other ETF out there that uses some form of covered call strategy writes covered calls on an entire index. For example, QYLD writes covered calls on the NASDAQ 100, which exposes itself to 100 different companies. SPY writes covered calls on the S&P 500, which is exposed to 500 different companies. And even actively managed covered call funds like JEPQ, which don't follow an index, are still very well diversified. Almost all of the YieldMax funds are exposed to just one company, with the exception of Treasuries, which is part of their option strategy. TSLY is only exposed to Tesla, NVDY is only exposed to Nvidia, and FBY is only exposed to Meta, and so on. Because safety is a really important part of my income portfolio, I don't like the idea of holding a fund that only contains one company. Literally over 90% of every position in my income portfolio offers some kind of diversification, even the REITs and the BDCs I hold. Real estate investment trusts at the end of the day are just pools of hundreds or thousands of real estate properties. BDCs are basically funds that hold corporate debt issued to small and medium-sized companies. But these YieldMax funds are significantly less diversified, which makes them riskier investments. To their credit, YieldMax has recently started offering diversified funds that hold several of their own ETFs. YieldMax, for instance, is one of their fund of funds that holds several of their own ETFs, which in my opinion is a better option. But even these funds aren't well diversified enough for me. I'm sometimes asked, even though I personally don't hold any YieldMax funds myself, what would I consider to be their best ETF in their lineup? And if I absolutely had to choose one, I would have to go with YieldMax for the diversification that it does offer. But YieldMax still isn't well diversified enough as it only holds 20 companies. My second reason for not holding any YieldMax funds is that I'm not confident they're suitable long-term investments. This really boils down to the main strategy that these synthetic covered calls employ. There's a big difference between regular covered call funds, which I like, and synthetic covered call funds. In YieldMax's own words, a traditional covered call strategy is an investment strategy where an investor sells a call option on an underlying security it owns. A synthetic covered call strategy is similar to a traditional covered call strategy in that the investor sells a call option that is based on the value of the underlying security. However, in a synthetic covered call strategy, the investor does not own the underlying security, but rather seeks to synthetically replicate 100% of the price movements of the underlying security through the use of various investment instruments. All covered call ETFs see limited upside when the underlying security is performing well. That's just the nature of these investments. But what we've seen so far with these synthetic covered call strategies is that when the underlying security is doing really good, these YieldMax funds appear to be doing worse from a share price perspective than other covered call funds that exist. What this results in is far worse times for the YieldMax ETFs. A good example of this would be TSLY. If we look at the performance of Tesla over the last year, we can see it's down 10.9%. It's no secret this stock has been doing poorly over the last year. But if we look at TSLY, we can see this ETF is down 50% over the exact same time span. Because of this, the amount of dividends this ETF pays has dropped significantly since its inception. Originally paying around $2 2 years ago, its last dividend was for only 69 cents. I would just like to ask a genuine question to everyone who owns TSLY. If it's your goal to live off dividends from this ETF, how do you expect to plan a budget around this kind of income? Imagine Tesla takes off in the same way Nvidia has. Obviously, every stock has good seasons and bad seasons. So assuming the underlying stock your YieldMax fund invests in is in a prolonged bad season, how can you budget your retirement with income that changes this much? If the goal is to live off dividends, you should be looking for income that's much steadier than this. Now, there's no denying that you can make really good returns with YieldMax funds when times are really good. NVDY, which is YieldMax's Nvidia fund, has done exceptionally well since its launch. This is obviously because of the AI boom we've been seeing with Nvidia. But the question we need to ask is, what's going to happen to NVDY when the AI craze starts slowing down for Nvidia, which is going to happen? Nvidia's stock won't return 180% every year for infinity. We've already seen TSLY go down in share price so much that they had to do a reverse stock split. It could be even worse for NVDY if there's a massive share price decline of their stock. And I get that sometimes, even with an investment that has seen a significant share price decline over time, it can still be a profitable investment if the dividends are massive. I've shown this before. CLM is an example of this. Despite the share price of this high-yielding closed-end fund falling over 95% since its IPO, because of the massive dividends, it's still been a profitable investment. It hasn't offered amazing returns by any means, but the fact that you'd be looking at a gain at all from a fund that's collapsed 95% is incredible. But this all still depends on if you're reinvesting the dividends you receive. If you weren't reinvesting all of the dividends, then your returns would be significantly less than what you're looking at right now. With that being said, so far nothing YieldMax has offered in terms of investments I believe have been suitable for an early retirement or living off of in retirement. I think that all income investors should be looking for opportunities that yield a maximum of around 15%, depending on the investment type or if it's trading at a massive discount. Almost always, anything more than this will involve a significant amount of risk. If you're living off dividends, you want to make sure that they don't change too drastically from month to month or over time. I know it seems like an early retirement is well within reach with these ETFs, but the issue with some of them is that you won't stay retired if your income drops this much. On this channel, I cover a wide range of high-yielding investment types, including REITs, BDCs, covered call funds, closed-end funds, MLPs, and others. These investments are all designed to offer high yields that are great options for aiming to retire early or live off of in retirement. They don't yield as much as synthetic covered call funds, but the income they do provide is still very high and you won't see huge dividend cuts or significant share price declines. You can still create a really good income stream with safer investments that yield high. Let me know your thoughts in the comments below, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.